episode 2 part 2. In my previous video, we talked about what Forex really is, as well as talked about some of the lingos that we are going to be using that we need to get ourselves familiar with as the episode progresses. So I'll just start with a quick recap before I continue from where I stopped. So by now, I think we should have that clarification regarding what Forex actually is. That is, when using the term Forex and when using it as a tag to a particular trader. So when you say Forex trader, you know these are traders that trade Forex currency pairs. Gold trader or commodity traders are different from Forex traders. Crypto traders are different from Forex traders. Stock traders are different from Forex traders, in as much as we all reference the chart interface, which is what you're seeing now. So without okay, let me just do a recap on everything that we discussed in the last episode. So we talked about some of the lingos we need to get ourselves accustomed with. Pips. Pips is just basically the smallest unit movement of whatever instrument it is that you are trading. We said lot size. Lot size is a reflection of how much in terms of volume of a particular instrument you are buying or selling at a particular given time. We said equity is your floating profit or floating loss together with your balance. You know, your equity is just telling you, okay, you've made a amount, so that amount together with what your balance is what your equity is. So that money isn't yours, or you haven't lost that money until you close that trade. Equity is just a reflection of the current state of your balance while you are actively in a trade. We talked about the bulls and bears. The bulls are the buyers, the bears are the sellers. A bullish market is when the market is rallying up, that is, people are buying and the price is going higher. And a bearish market is when the market is being that is when the bears are the major participants, that is when the market is going down. Stop loss, as we said, is our safety net should in case the market is going not in our direction, that is if it's going inversely of what we wanted it to go. So then we should always have that safety net so that our brokers take us out of that particular trade. We also talked about support and resistance level being support being like a ground where prices is expected to bounce off while it is falling. Then a resistance level is like a ceiling that is going to withhold that particular price from going higher than it should. So we talked about take profits being an anticipated profit level. We talked about leverage. We haven't talked about leverage. So in this video, I'm going to be continuing with leverage. So to help you better understand what leverage is, I'm going to be referencing lot sizes as well. So remember in the previous video where I talked about the three types of lot size, that is the micro, the mini, and the standard. And I said the micro is when you are using lot size like 0.01 to 0.09. The mini starts from 0.1 to 0.9, while the standard starts from 1 and above. So 1, 10, 20, 50, 100 lot size. So these are standard lot size. So to further help you understand what we are going to be discussing, we also need to know that when you are using a micro lot size, you are buying or selling 10,000 units of that particular instrument. So when you use a micro lot size, you are buying or selling 1,000 units of that particular instrument. When you are using a mini lot size, which is 0.1 and above, that means you are buying or selling 10,000 units of that particular instrument. And when you are using a standard lot size that is 1 and above, that means you are buying or selling 100,000 units of that particular instrument. So this actually is this is essential in our discussion because now when you say using the micro lot size means you are buying 1,000 units, and using the mini lot size means you are buying 10,000 units. And this is 0.01, that's the micro units, 0.1 and above, that is to 0.9, that's the mini, and 1 and above is the standard. So this is how you should look at it. By default, this is me trying to use the lot size to explain what leverage is. So leverage is this is where our broker comes into play, because by default we ourselves we can't participate in the market because we don't have the substantial capital to do so. So your broker come into play by giving you leverage to participate in the market. So you with your $100 can't do much in the market, because the smallest units, when we say you're using a 0.01, the micro lot size, that means you are buying 1,000. Let's use gold for an example. Now let's say I want to place a buy position on gold. So the smallest unit of gold I can actually buy is 1,000 units of gold, which let's say maybe when you have $1,000, then that means you're actually buying. So even with $1,000 you can't actually, because there are some fees you have to sort out, which that 1,000 wouldn't be enough. Let's say $5,000 now. Okay, let's say you have 5,000. Okay, if you have 5,000, then maybe you can actively participate, because that 5,000, the margin that is going to be collected for helping you place that trade, as well as the broker spread and whatever it is, the fee that is going to be needed for you to put you as a participant in that trade, after it has been deducted, then and your capital, like, and your account, after this deduction have been made, so you should still be able to participate in that trade. So this is me using the $5,000, like that's if you have a $5,000 to actually trade, and this is still like the micro lot size. So basically what I'm trying to say is that we, with our own money, like you only have to have like a very huge amount of money. So while we are at it, let me just discuss the major participants in the forex market are usually the central banks, that is the central banks of the US, the central bank of China, whatever have you, these major world countries. So these are the people that define the monetary policies. They influence the market majorly, and hedge funds, giant tech companies, like these are the big guys that the markets are made for. So people like myself and you that are just looking to make this quick cash off of the liquidity and fluctuation in price, we are called the retail traders. So the market is like, once if you don't have a substantial amount of capital, you can actively participate. But with the fact that we have brokers gives you leverage and help turn that your $100 now to, let's say, whether 10,000 or 100,000. So this leverage is based off of what the broker is offering. So in some broker you see a 1 to 10 leverage, some you see 1 to 100, some 1 to 1,000, some brokers even have 1 to an unlimited amount. So the quick math there is that once, if a broker says he will offer you a 1 to 10 leverage, so that basically means if you are bringing $100, that's $100 times 10, which is $1,000. So now your purchasing power or your selling power in the market is equated to that $1,000, which that means you still can't use a mini lot size. Remember, a mini lot size starts at 10,000 units and above, up till 90,000. A standard starts at 1, which is 100,000. So if the broker gives you a 1 to 10 and you have $100, so your purchasing power is limited to 1,000 units, which is still below which is just a micro lot size or micro unit. So this is a very important knowledge, because most people that comes into trading, they don't put this into consideration, and they use lot size that are bigger than their account sizes, and within just a single fluctuation in the market, all of their capital is wiped. So I wouldn't want to waste much time, because of course we are always going to explain further as we proceed, but I just like you to understand that leverages is what the broker provides to us for us to be participants in the market. So, and the leverage, this leverage is not static, it varies via brokers. Some brokers will do 1 to 10, some 1 to 20, 1 to 50, 1 to 100. So the quick math there is just that anytime you see this kind of leverage, you just take your capital, that is whatever amount you as a trader is bringing to the table, you multiply it by the leverage the broker is providing to you, and that gives you your purchasing power. That should always also tell you how much lot size you are supposed to use and what lot sizes you are not supposed to use. So that's this is one of the foundations of trading that every trader has to know, because this will help you in determining how your risk management is going to play out, that is how much you should be willing to risk per trade and whatever have you. So that's a brief explanation regarding what leverage is. Then we come to time frame. So when you talk about time frame, in the forex industry, there are different time frames, and these time frames too is relative to what kind of a trader you are. So now that we are there, let me just quickly explain to us too that in the forex industry there are different types of traders. We have those who are the scalpers. The scalpers usually use lower time frame, like the 15 minutes time frame. These are people that want to get in fast and get out fast. They just they basically just look for that high fluctuation of volatility moment, just to get their quick bucks and they're out of the trade. We have day traders. Day traders are like myself, that comes to the market. We come to the market every day to look for our setup and look at a good entry point to join the majority, that is whether to buy or to sell. You see, the thing about forex is that forex is actually hard, but then it's still not really hard, because you are just doing two things: is either you are buying or you are selling, or most likely you are waiting for your setup. So now the issue there is where are we going to buy and where are we going to sell, or when are we supposed to buy and when are we supposed to sell, and when are we supposed to stay out of the market. So this knowledge is what separates profitable traders from non-profitable traders. And for you to get this kind of for you to get this kind of a knowledge, it comes with you doing a lot of study, getting yourself familiar with the different market life cycles. So the time frame, as I was explaining, we have some of the major time frames that are generally used among traders are the 15 minutes time frame, the 30 minutes time frame, the 1 hour time frame, the 4 hours time frame, the daily time frame. So yeah, these time frames are the major time frames, although nothing is subjective. Different traders with the different time frame that suits them. So another thing that I need to touch on quickly is that when you are in a particular time frame, each of the candlestick that you see here, we call these candlesticks, that is each of these bars, whether the blue bar or the red bar. So let me quickly chip in that the blue bar indicates buyers while the red bar indicates the seller. But then for every movement, that is when the market is either in an uptrend or in a downtrend, this is more of like a tug of war between both the buyers and the sellers. That is, the market doesn't move just in a straight line, it moves in what we call a zigzag motion. So for every time prices are going higher, you see the influence of these sellers trying to bring price lower, but at the end of the day, the majority, that is, if the buyers are the majority, the price is always going to be climbing and creating new highs. So these points are what we call highs in the market. That is what the characteristics of a bullish market, that is, or a uptrend market, is the creation of new high. So, and this is what I mean by new high. That is, this was the previous high, this is a new high, this is a new high, this is a new high. So the continuous creation of new highs and higher lows is what is, that's just the characteristics of an uptrend. So, and if it's a downtrend as well, the market is always going to be creating new lower highs and new lower low, new lower highs and new lower low. So this is just something I just wish to chip in. You don't necessarily need to to know about it like deeply, because as I said, this is not me trying to teach forex, but this is just me enlightening you about how the forex market works. So it doesn't hurt to actually know this. So then the trading tools, yeah, this is very important. So in the forex market, we do, like, most at times, most traders use these four tools like judiciously, starting with the trading view, which I introduced to us in the previous episode. This is trading view, and this is where most of the analysis is done. You do, and by analysis I mean, this is where you determine who is in charge, that is, whether the buyer or the seller. Once that have been determined, then this is where you determine, okay, based off of your strategy or whatever have you, where do you want to join this majority in continue to buy or in continuing to sell. So, and this is also where you define your risk. So you don't define your risk totally here, there's also another tool that helps you in completing that. But this is how the flow looks like. You come here, you do your analysis, then once it's time for you to define your risks, maybe based off of where you want to enter from. So in this example now, let me say I want to take a buy position at this level, that is at price $4,171.294 per ounce. Let's say I want to buy gold. So, and I'm trying to set my stop loss now, which is a price below that level, because I'm trying to buy now. I don't expect that the price should go down. So, but if the price eventually go down, then I don't want to lose, because once your trade is going against you, that means you are going to be losing money. But based off of the risk I'm bringing, or the risk I want to take, I want to say, okay, once the price is below $4,153.047 per ounce of gold, I want to exit that trade, which is I want my broker to exit that trade on my behalf. So this stop loss now, now this is where we get to reference the previous knowledge I shared. So talking about pips, some places you can see it as ticks. Once you see pips or ticks, it's still referring to the same thing. So for this particular trade now, for demonstration's sake, this red zone here, so the measure of my risk, this is 182 pips. So I'm just focusing on the first 3 digits. So these two might sound confusing, but let's just tag along and understand what I'm trying to explain, which is how the 4 tools, that is the tools that we use in trading, how they relate with each other. So the idea is that I do my analysis, I see my entry, and I start to anticipate to take that trade. So I define my stop loss here. The pips value of the units I'm trying to trade is 182 pips. Then I go to, there's a platform called my FX book. Inside of my FX book, there is this calculator, position size calculator for the different instruments you are trading. So what I just do is to include my account size, as well as include the monetary amount I'm trying to risk. So let's say I want to risk $100 on this particular trade. Then I impute my stop loss gotten from here, which is 182 pips. Then I remove 10 here and click on calculate. So now what this position size calculator does is to help me is to help me evaluate what lot size I should be using so that I don't risk more than I specified. So I'm saying I want to risk $100. Basically, I want to risk $100 on this particular setup. So if the setup goes against me, I don't want to lose more than $100. So for that to be for it not to for me not to lose more than $100, I have to use this 0.05 lot size. So this 0.05 lot size is now what I take to my MT5. Remember I said my MT5 is where we actually place our trades. We only use the trading view for analysis. So although trading view now is sophisticated enough for you to connect your broker to and place a trade on, but most traders prefer to do it on MT4 and MT5. So here is where I will now put the 0.05, then click whether the buy or the sell. But because the market is closed now, that particular trade is not going to be executed. So a quick recap: we use trading view for our analysis, we use MT5 or MT4 for our trade execution, we use my FX book XAUUSD position size calculator. So you can as well calculate your position sizes for other instruments here, but because I'm trading gold, that's why it is selecting XAUUSD in my own view. So but you can always change that to whatever it is you are trading. So and the last but not the least, which is the Forex factory. So this Forex factory basically is just for you to keep up with the news, because I mentioned that the major participants of the market that influence the market behaviors are the big guys, the banks, the hedge funds, and whatever have you. Like, these are the guys that the giant tech companies that trade huge amount of money. So these are the guys that influence the market. But then you also want to pay attention to the fundamentals. So now that I mention it, it's also good to differentiate between the two types of traders. We have traders that trade based off of just news. So news is still the same thing as fundamental traders. So some traders will tell you they are fundamental traders. Once you hear fundamental traders, just know that these are people that trade based off of news event. So is either you're a fundamental trader or you're a technical trader. But then in as much as you are a technical trader, you still have to pay attention to the fundamentals, which are the news, because this news used to have ripple effect in the market. So some are usually, not most at times, they are usually like, the effect are usually for a very short period of time. So is either you stay out of the market during those particular news release time, or you should have already been in the market, because during news volatility is very high. There used to be high slippages whereby your order gets filled in where you did not specify, causing you to lose more than you are supposed to lose. So I think this brings us to the conclusion of episode 2, where we've discussed some of the lingos. There might be some lingos I didn't mention, but then be sure that I'm going to do that as I remember, or should, when I'm explaining a particular concept. So in order not to make the video longer than necessary, I'll catch up with you guys in the next episode, where we'll be talking about the roles of brokers. So yeah, we've talked about them briefly, but then I'll try and expatiate and going to how they participate or contribute to the whole Forex ecosystem. So catch us in the next video, and thank you.